I'm going to call to order the meeting of the Retired Employees Healthcare Benefits Trust. Let's begin with the Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. I note for the record attendance. I am Treasurer Michael Shostak. Here is Trustee Chris Kolinsky. Finance Director Jason Tice is unavailable today, so will not be joining us. So it'll just be the two of us. A quorum is in attendance. At this point, I'll open the floor for public comment. If anyone from the public would like to address the Trust Board. Seeing none, I'll close public comment and move on the agenda. The next item is the approve the minutes of the May 2nd Trust meeting. Any comments or questions? And if not, then I'd look for a motion to approve.
So moved.
Motion by Trustee Kolinsky. I will support that. All those in favor say aye.
Aye.
Aye. All opposed? Okay, that passes 2-0. Next item, number 5, quarterly portfolio review. We have Mike Holycross here from Mariner Institutional.
And Brian Green sends his regards. He had a previous obligation, so with these meetings on Thursday, we're kind of a backup here and there. So I'm happy to be here to talk to you about your quarterly results. It was a bit of a strange quarter in terms of capital markets. Let me at least show you what happened in the with regard to the indices for the month and the quarter for Q2. So if you just looked at the broad number, S&P's up 15.29%. You think pretty good year so far for equities, right? But you'd be remiss if you ignored what's going on in small cap land, mid cap land. It's really been a tale of two cities. When you look at the quarter for the S&P 500, up 4.28%. I know, Brian, throughout 2023, we spent a lot of time talking to clients about the Magnificent Seven, kind of driving the returns for the S&P 500, those 7 tech names, and then the rest of the S&P kind of left behind. The issue with this year, it's gotten even more narrow. So that 4.28%, 5 stocks accounted for that 4.28%, 100% of that return. 400. So if you took the S&P and then went 495, those stocks were down 2.78%. So a big diversion between who's winning and who's losing. We've seen a bit of a reversal in that in the month of July. Rates have come back to us quite a bit, so it's going to be good for fixed income. Equity markets have broadened out quite a bit. We've seen one of the largest rallies relative between small cap and large cap in the month of July, and that's more on the if somebody would look at that and say normally, okay, the markets are believing we're at the beginning of a early cyclical rally. Good news for the economy, because that's when small caps would typically do better. I believe it's more the markets believe we're going to get cuts, 2 cuts this year. First one in September. Fed kind of alluded to that yesterday, and that's why you saw the market rally again. And small cap companies generally have more variable rate debt and more debt in general on their balance sheet than larger cap companies that can access the capital markets in different ways. And so if rates were beginning to come down at the end of 24, beginning of 25, then small cap balance sheets should look a little bit healthier. And you saw this huge rally, 12 to 15% return dispersion in small cap versus large cap. And we haven't seen that in a lot of years, because we've been talking about this large cap growth, 5 to 10 names that have really driven performance. You can see just more evidence of that on a year-to-date basis, or even the quarterly basis for large cap growth at 8.33 versus value, large cap value at negative 2.17. So again, over a 10% return dispersion between growth and value. And then on a year-to-date basis, growth's up almost 21% versus 6.6 for value. International stocks are represented by the EFA. Those are developed markets. Think Europe, Australia, Far East. That's what the acronym stands for. and then emerging market stocks, that last line down there. So on a year-to-date basis, up 5.3 and 7.49 respectively. So not rallying nearly as much on international non-U.S. companies. And then the fixed income, U.S. aggregate. So rates were pretty volatile during the quarter. Rates went up aggressively in April, which means prices on those bonds come down. So we saw negative returns in fixed income land. Stabilized in May, came back to us a little bit in June, and with the Fed's announcement yesterday, moved down even lower. I looked up rates yesterday. You look at the 2-year key rates, 2-year Treasury, 10-year Treasury. These are just yields. So as of 6:30, by example, the 2-year Treasury was at 4.75%. We started the year at 4.25%. And it seems like each month we may get 10, 20 basis points up or down in either direction. It's been extremely volatile. And then the 10-year at 4.40% year end. Yesterday morning, 4.104%. And after Powell's conversation yesterday with the markets, rates even came back even more. The market getting a little bit more confident that we are going to see a September cut, and then maybe one towards the end of the year. They certainly don't want to cut twice before the election to try to impact what may happen in November. So at the beginning of the year, the market had really anticipated and priced in, when you look at the Fed funds futures rate, about 6 rate cuts this year. We thought that they were way over their skis. It was way too aggressive. The Fed pretty much made that known in the first 4 months of the year, so rates spiked. The market's getting a little bit more comfortable that we may see 1 or 2 rate cuts this year. Inflation data certainly proves out they're going to be allowed to do that. We're starting to see for the first time some softening in the last 90 days in the labor market. And certainly, I think there are cracks you're beginning to see, at least for the consumer. I mean, how much longer can people afford $4 gas and $200 at the grocery store? It makes an impact at some point, and we're going to see consumers push back, and the by and large the stimulus monies that have been used from post-COVID have been worked through. So it's going to become more and more difficult for the consumer to continue to participate and spend at these levels. And so if you look at the very bottom, the sector returns on a year-to-date basis, it's no surprise by what we looked at in the indices on the sectors that are driving: information technology, communication services, 2 best performers, and then you can see the S&P 500. Every other sector is below the average return for the S&P 500, with only real estate in negative territory, and that's more to do with rates rising, right, and the impact on those publicly traded REITs. All in all, relatively good news. The issue, when you look at your overall performance, you're going to see a wide dispersion. Value didn't participate. Small cap stocks did not participate, and that's going to show up in some of your line items here. So I'll flip forward. This just shows the values. And now, as of June 30, 2024, one VEBA fund where everything's aggregated together at $27.7 million. A little bit cleaner from an accounting standpoint. And then performance. So what helped, what hurt? Total fund performance is up 46 basis points for the quarter. On a 1-year basis, I'm up almost 9.5%. So certainly having the passive indices, by moving to the Fidelity, lower costs, we're getting broad representation. So that 15.29% in the S&P 500, regardless of the weights of some of these active managers, we're getting 100% replication of that. So that has helped. The decision to start to diversify away some of these active managers in the small mid-side by adding Reinhardt to complement the Clarkson portfolio has certainly helped. And Edgewood, which is your growth exposure in the portfolio, while underperforming the growth benchmark, has outperformed the S&P 500. And we'll talk a little bit about some of the reasons why they underperform. So your large cap value portfolio is Ancora. This is run by a firm over here in Bloomfield Hills by David Sowerby and his team, which is out of Cleveland. down 1.04% compared to negative 2.17%. For the quarter, they outperform over the last year. They've done well in some of the tech names. They hold Apple, they hold Broadcom, they hold Microsoft. They had CVS in the portfolio. They sold after quarter end. And they've had Nike in the portfolio, which has had a difficult 2024 so far with some global inventory issues. We mentioned the 5 stocks in the S&P kind of driving returns. Everything else is in negative territory. Edgewood for the quarter up 289 versus 833, up 27%. So from an absolute standpoint on a one-year basis, pretty strong number because they're participating in that growth rally. But NVIDIA, it's a 22 stock portfolio. So a maximum position allowed if a stock rallies is to go to 8% mandatory trim. It's just a normal risk control. So over the last 3 years on NVIDIA, which has been their largest stock holding, they've trimmed it where it wasn't the largest stock holding. It rallies again, they trim it back. So they've done this 10 times in the last 18 to 24 months. After quarter end, it is now a 5% position. They just took a ton of profits off the table. You compare that to a Russell 1000 growth where you're at 12 or 13% weight for NVIDIA. Same thing for Apple, 12 to 13% weight for Apple. And they hold 0 in Apple. They sold that a number of years ago. Hence why you see some of your value managers picking up Apple and Microsoft. So those are going to hurt. They've been underweight Microsoft, but they do hold NVIDIA. They do hold Eli Lilly, which was one of their recent additions 18 months ago. Netflix, which was a stock that 2.5 years ago we talked about as being a difficult performer. There were some issues with how the market was going to understand this ad-based revenue model. And once the market kind of realized a year later it was going to work, the stock has really skyrocketed. And I think what's interesting about Edgewood, it's a part of the strategy that we really enjoy. There are 6 partners, portfolio managers that make decisions. It's got to be a unanimous decision to get into the portfolio. If a stock has underperformed 2 or 3 quarters in a row and misses earnings, or goes down by X%, it gets the introducing team, the analyst and the portfolio manager gets taken away from them. And it gets re-underwritten by a new portfolio manager and a new research analyst. And they come back as if it's a brand new stock. Would we buy Netflix today? And the team came back, Larry Creel did the re-underwriting, and they said, yeah, we would rebuy the stock. So they added to it. So in the last 18 months, it's been a pretty good performer for the portfolio. They also hold Lulu, much like Nike, which is seeing larger competition globally and then some global supply issues. So that hurt in the quarter. And a long-standing holding in the portfolio, American Tower, was sold, and Illumina in the portfolio. So after quarter end, Illumina was the most recent stock sold. We just haven't seen the growth prospects that have been promised in the last 3 to 5 years. And so they found another opportunity to invest into. Clarkston, probably one of the more disappointing in terms of relative and absolute performance, down 6.21 for the quarter versus negative 427. So we're not surprised in a market like this. It's being driven by 5 to 10 growth names and a lot of momentum, that a manager like Clarkston is going to underperform. We understand that. If recall back, and this kind of goes outside the 12 to 18 month memory that investors have about markets, in 2022, the markets were down 20+% in small mid-cap land. They were 0. So they provided 20% downside protection. But people look at the last year now and realize, well, at some point we got to start participating in this rally. And it's difficult for them given their deep value philosophy. So some of their bigger names, Clarivate was a new name, was one of their worst performers, and Leslie's was a new addition about 12 months ago, pool supply company. Just hasn't moved out of some of this disruption in inventories to return to the growth that they thought they would sooner rather than later. So those are the biggest impactors. The Reinhardt Partners, this is a small mid portfolio that was added May 1st. So funding took place in April of this year. Good decision. That portfolio's done well. We've got the Fidelity Extended Market Index Fund, which gives you exposure to small and mid cap, broad exposure to the index replication. Oakmark on the international side, deep value, which has hurt them in this market environment. We talk about growth in the U.S., and it's the same story, growth overseas. Negative 421 versus negative 60, and that 1 year number, a negative 2.8 versus positive 11.22. As Brian and I have talked about this, Michael, and I think Brian has mentioned to you as well, this is probably an area of the portfolio. Let's get some broader diversification and perform a search to look at potential replacements for Oakmark.
Yep.
What we've seen over the last kind of 5 years with Oakmark, because of this deep value, is a little bit too much variability, and too much variability to the downside relative to where other managers are and other indices. And then the index fund for international, JP Morgan Emerging Markets up 3% versus 5%. And then the Baird Intermediate Bond, so a little less interest rate sensitivity, has helped because of the volatility in rates over the last couple years. So that has certainly helped the portfolio. You think about the aggregate bond at best being flat over the last year. This portfolio is up 4.83% because of that lower volatility and lower exposure to interest rate volatility. That's a broad summary of each line item. I'm happy if there's other pages in the book if you'd like to go through. You see this in the S drive?
He didn't give me the file for that.
We did.
No.
Let me just hand out a couple pages.
Okay. Maybe you could talk about the asset allocation, page 6.
Yes, in line, touch over on the domestic fixed income side, but with the addition of new.
Next slide.
There we go. Oh, you
There
can
you go.
control a
Thank you.
hand item. Perfect. With the addition and thoughts of new asset classes, that overweight to fixed income can easily be reduced just outside the investment policy max. Thank you. So you can see on the REC, what this page represents is investment policy constraints. So the gray bars are the minimum and the maximum. The vertical black line is the target allocation. So you can see everything really close to being in line, but because of the addition of alternatives and real estate as separate asset classes now, there's a slight overweight to the fixed income side, which can be used as part of your funding source for new ideas. And that won't happen immediately. You want vintage year diversification. So that'll happen over time as we identify asset classes, as Michael and Brian identify and talk about new strategies that make sense for both portfolios. We'll implement those. Fixed income will be a source of funding for some of those asset classes. So on the RHC on the top of this page, see the target allocation for real estate is added at 10%. We'll take our time getting there. This is not the time to jump in with both feet, and certainly anytime you start a new asset class at either 5% or 10%, you want to work years into funding that for private equity, private real estate, private debt. So we've had commitments made to Bloomfield Capital Fund 5, $3 million, and then certainly under consideration, and as Michael Shostak has commented, with Capital Dynamics, this is a private equity portfolio. Secondaries portfolio, we love to start private equity portfolios with secondaries because we get immediate vintage year diversification. Capital Dynamics is going out and buying things in the open marketplace on secondary transactions that have already been placed in the marketplace, and they're typically buying for 80 cents on the dollar. So if they underwrite it at 80 cents, we're already getting an immediate uptick in returns. First call for that. If it is a September, we finish the paperwork first call, they'll put 40% of the capital to work on that first call, so we'll have good implementation. Capital Dynamics, again, we did this 18 plus months ago for a different client portfolio, same fund, so we were in an early close. This will be one of the final closes. They're up 62%, 1.4 times capital already value in the portfolio. So off to a very quick start. The second page gives a summary of Bloomfield, and then Capital Dynamics is the third page. We create these summary pages, descriptions of what these funds actually do. So Bloomfield is a lender, a bridge lender. Think loans at 12 to 18% or 12 to 18 months in duration, collateralized by real estate. If they underwrite something and want to lend on anything other than real estate, they have to notify us first, just so we can inform our clients. So they're now on Fund 5, Series C, so they've had 8 different tranches of lending over the last 15 plus years, with success in exceeding their hurdle rates. So this is, this is a strategy that is low risk, no leverage. While they have the ability in their documents to add leverage at the fund level, they've never done it. And it's something, again, we would ask them to come to us to discuss if they think it makes sense, but they've never have in 15, 20 years in business. And then Capital Dynamics, we kind of talked a little bit about it already, but you see on page 3 the description of the firm, the team, the strategy. This is a fund that we would expect over time, while it's off to a great start early on, net returns of about 15%, but we want to see something north of 1.5 times value returned on the money, and they have done that historically. This is one of the better secondaries team. They've been doing it a long time. Anything else on that, Michael?
All right. Any questions, Chris?
Yeah, a couple.
Yes, sir.
We were specifically talking about kind of Edgewood, Clarkson, and Oakmark. You've
Yep.
talked about Oakmark might be an area where we're going to consider finding a replacement. We've talked about Edgewood and Clarkson for many years, specifically not only here, but in Financial Sustainability Committee. I mean, again, 1 year numbers is fine to look at. Again, Edgewood is trailing 6+%. Clarkson is almost a 12% delta against our benchmark, and it's a 13% delta for Oakmark. That's just a 1 year. Again, when we look at the big picture though, Edgewood is down 8% since its inception, and Clarkson's only 1%. Like, those are deltas that's hard for us to make up over time. 8%'s that's not a 1 year miss or a 2 year miss or a change in the capital markets. It makes me strongly doubt that this should be where we put our long-term money in Edgewood. What is your thought on that?
Edgewood over a 20-year time period is one of the best large cap growth managers you're going to find. And you don't have that data because your inception date is 12/1 of 2020, right? So you don't have the benefit of hindsight. The underperformance, the greatest underperformance of that is coming from 2022 when growth sold off pretty aggressively and they did underperform. They've turned that portfolio over not quite 50%, but one of the largest turnovers since 2008, 2009 time period. And they went through a 15-year, 14-year outperformance where they were one of the first or second best percentile performance against growth managers. But you are correct in what you're seeing here is hard to digest, but they're living with that 2022 performance, and so it's very endpoint sensitive to having that in there.
How much money do we have allocated in Edgewood? I didn't find that page.
Page 5, go 1.
For the retiree healthcare, we have
500,000.
No, we have
2.9, so
2.95.
10%.
Oh, that was before the allocation.
2.95.
10% of the portfolio.
Okay, I'm just trying to figure out how much is that. Are we going to continue to wait for it to rebound, or if we're missing out on an 8% delta for that 2.5 million, what is that compounding? Like, eventually, what is the lost revenue getting us? That's my worry.
We are comfortable with Edgewood as a manager and a strategy. It's why we have it blended with a value manager and the index fund. They're both, All three of those are about 10% weights of the portfolio. So some of them are going to outperform, some are going to underperform, and then we always have a good chunk to the index fund as well.
And I get that, right? We balance out, we're diversifying our risk. This one continues to weigh down our portfolio. That's all. So.
Why don't we, let's revisit that next quarter, when we compare, we'll revisit all the owners, because we're going to look at Oakmark.
Okay.
What was the other one that we wanted to look at?
Well, we're
Clarkston.
still talking about Clarkston, given the last year's
Yeah.
performance. So they have a great 2022.
Yes.
But our memories don't go back that far, right? So we think about the last 18 months and they've underperformed. But that's been driven by growth, by momentum. You know, in the case of Edgewood, as I mentioned, would you want the same exposure as the S&P 500, where you've got 13% in Apple, 13% in NVIDIA? It's just heavy concentration, and they've taken some of that singular name risk out of their portfolio.
No,
It's hurt them.
No, and to your credit, I appreciate you bringing those points up. I understand that. But after a while, eventually years of missing earnings that were compounding missed interest, and it ends up being material to us. So when I keep seeing that we're under policy, we're missing our policy index associated with our returns over and over again, eventually I'm worrying that we're missing the interest. So again, I don't get upside gain and I don't get downside protection, so I'm just missing the returns.
On a rolling 5-year basis, back to inception of the firm, they're over a 90% batting average. That's how good they've been. We're not living through that period right now.
And that's what I have to look at.
Yep.
That's what I have to base it on. So, because we need to get this fund to a certain dollar amount that it can start paying its dividends out. We need
Right.
to get to that. So,
Okay, any other questions?
no, thank you, Michael.
All right, if there's nothing else, Mike, we talked about new investments. You brought up the diversification already, based on the new investment policy that the board approved. If there are any other questions or comments, I would look for a motion to adjourn.
So moved.
Support, and all those in favor say aye.
Aye.
Aye. Opposed, and the ayes have it. This meeting is adjourned.